Hi everyone, thanks for joining into my video update for November 7th. We actually just got back from Royal LePage Frank Realty up in Uxbridge where I gave a presentation. So I'm just going to share with you guys, what I shared with them. It's a very big slide deck, but we're going to go through it pretty quickly and go from there. All right. First and foremost, I've addressed this once and I'm going to address it again, the condo market. It's clearly taken a beating if you take a look at, all other, properties out there. This property segment has been impacted quite a bit, but, with increased demand climbing back up, people, entering the market now that interest rates have started to decrease, I'm seeing condos being a segment where people are looking to get in here. Now, I've had this happen now 2 times in the last month where, people are going to need to be aware of price versus value. You'll be able to get a pretty good price for your condo, but your price is going to be what you're paying for it, what you and the seller are going to be negotiating and coming in agreement to purchase it. The value is going to be what is that actually valued out on the market. How does it look in comparison to different comparable properties that are being sold in the area. So realtors, please be very aware of the market that you guys are selling in, and what that value is going to come up at when we do get those properties appraised. I'll let you know this. My mom obviously works at Scotiabank. She has seen quite a bit of appraisals coming in low over the last couple of months, and just in this last month, I've had 2 condos come in undervalued when the appraisal comes in. So you guys have to make sure that you are aware that you're putting in finance clauses, those finance conditions to protect your clients, etc. Now, it's not all doom and gloom for condos. I will say this, this is the HPI data here, and you guys can kind of see, we have single family homes and then we have apartments as well. Condos are, they're lower than what single family homes are right now. But if you look at it from a seasonal aspect, as of recently, you can see that when you are looking at those troughs, especially as of recently, right? So you're going to be looking at the far side of the graph. The lowest point is in January. So again, we're approaching those January lows. The condo market is going to be poised for a push back up when we get to that spring market. Again, this is seasonal. The HPI data is going to give you guys the value of these different segments. So it's a very interesting graph to take a look at. Again, point being, it's not all doom and gloom out there for condos. So we're going to get into our economic and rate update. We're just going to share real quick all of our graphs that we brought to Frank Realty this week. First and foremost, we have CPI. Now, I have provided the most recent months of CPI data, and you guys will be able to take a look at the graph here. The dark blue line is going to be your headline CPI, whereas the light blue graph is going to be CPI excluding gasoline. You can see that's the closest that we're going to be able to see in terms of a graph with what core inflation is. That's actually the Bank of Canada's preferred measure. So that's going to be a closer indicator to what the Bank of Canada actually prefers to measure their CPI at. And you can see that it's a little bit higher than where we have headline inflation right now. Headline inflation is coming quite down, but CPI excluding gas is a little bit higher. That kind of opens the door still for the possibility of a 50-point basis cut decrease in December. And then again, you guys will have the decreases in, the meetings in January and March. The next CPI report that you guys are going to want to take a look at this month is going to be coming in November. You're going to want to take a look at where CPI comes at. Bond yields. Where are bond yields? Bond yields have actually been acting kind of in the inverse of inflation and the inverse of the Bank of Canada's monetary policy. Monetary policy is coming down where bond yields are coming up. Bond yields are going to be what fixed rates are based off of. So typically, I haven't seen increases across the board with lenders on their fixed rates. In general, they still are trending down. However, this increase in bond yields definitely adds towards upward pressure. There has been a lot of downward pressure in the last couple of months, in the last 2 months, let's say, this is just going to kind of cool those downward pressures and bring it back into reality. Where do I think everything's trending? I still do believe everything's going to trend down eventually, but again, that's something to keep in mind. Make sure you guys get your pre-approvals, have rate holds, so that your clients aren't left holding the bags when interest rates, if they do come up on the fixed side. Now let's take a look at where rates are going. We're not just going to take my word for it, we're actually going to take RBC's word for it. This is their forecasted chart for what we can expect for Q3 and Q4 in 2024. I know that we are now in Q4, but let's just take a look at it, and I promise it'll all make sense on the next slide. So the overnight rate that we saw on the last slide, I've now just kind of neatly put it in front of you guys here and converted it to prime. Now, RBC predicted that going into the fourth quarter of 2024, we are going to see a 50 basis point rate cut. Well, that happened. We know that it is now, prime is now at 595. So now RBC, in that same prediction, in that same forecast, they're predicting that prime is going to be decreased by another half a point. So going into the first quarter of first quarter of 2025, you guys can take a look, and the market is expecting another 50 basis point cut. Now, finally, I'm not going to touch too much on unemployment, but I have had some realtors ask me, hey, you know what, our unemployment isn't doing as well as the US's. The US's market is, it's buzzing right now. It's a lot harder than ours, whereas our GDP is nowhere close to theirs. Our unemployment is on the increase. Well, take a look at the slide. The graph on the left, that's unemployment. The slide on the right is actually the share of newcomers joining the labor force. Now, again, I'm not including any of my specific opinions on this, but all this information is derived right off of the Bank of Canada's site, and they've actually indicated, and it's not hard to find this on their first page, they've actually indicated that the rise in unemployment is due to a growing share of new workers joining the labor force without a job. So there's a certain amount of jobs. It's not that a lot of people are being laid off at this point or being fired at this point, but it's simply just we are adding new people into the workforce, and those new people in the workforce cannot find jobs. So that's going to lead us to where rates are at right now. On the 3-year fixed for a conventional deal, you're looking at around 4.64. On an insured mortgage, again, a 3-year, you're looking at 4.29. I'm actually, telling clients, take a look at the variable rate. It's going to be a hard pill to swallow because the rates are a little bit higher, but based off of these forecasts that I just shared with you guys, interest rates are expected to decrease by another 50 basis points. They're expected to still continue to decrease in 2025. So variable rates are only decreasing, whereas if you lock into a fixed rate, that's the rate that you're going to have for the next 3 years. You might be able to play it smart. It is a little bit riskier with a variable rate, but again, it might not be too bad. You guys will be able to lock in whenever you want it out of the game, or it became too risky for you. But again, I think variable rates are something that clients should again continue to consider now that rates are steadily on the decline. Now, I shared a lot more stuff at my presentation with Frank Realty in Uxbridge today, but I'm just going to leave it off here with rental cash damming because I believe it's important. Essentially, what rental cash damming is it's a way that you can maximize the amount of mortgage that you have that is tax deductible. And again, it's specifically for clients that have rental properties. Essentially, what you do is you're going to have a line of credit plus a mortgage on your principal residence, and you're going to be using that product to be able to maximize the tax deductibility of your rental property. Again, if you have a rental property and you are not doing rental cash damming, then you're definitely missing out on a lot of savings, and you will be paying your mortgage longer than you would if you weren't doing rental cash damming. Now, one last piece of information is at our brokerage, we have a special division that does this specifically. So we have a mortgage agent that works with clients specifically on this, as well as an accountant that works with clients specifically on this. Again, this is a CRA approved strategy for clients. But again, you have to do it in a way that follows the tax code and everything like that. So again, if you guys have clients that have rentals and they're not using this, feel free to refer them. Again, are likely missing out on a lot of tax savings, and I'd be happy to have those conversations with them. So thank you guys so much for listening. I'll see you in the next one.